Hello and welcome to the channel. It's your boy, Mr. Steve. And in case you missed it, here's the smart money news you can use. New analysis of U.S. jobs data originally provided by the Bureau of Labor Statistics suggests the economy may have been adding about 60,000 fewer jobs per month than previously reported between April and September of 2025. This revised estimate is based on analysis by Federal Reserve economists. Now, but real talk, a slowing job market hits consumer spending, wage growth, and overall economic confidence. This kind of data absolutely influences how the Fed thinks about future rate cuts and the overall direction of the economy. And yes, this kind of data is so important. So much so that the Dow dipped after the new jobs report analysis. The Federal Reserve just cut interest rates for borrowing again, and this time we're hearing directly from John Williams, the president of the New York Federal Reserve, who says the Fed feels it's in a good place heading into 2026. Williams also made it clear, though, the Fed is worried that job growth is slowing faster than inflation, which is why they're easing up on those interest rates. He basically said, even with the labor market clearly cooling, the Fed's goal is still to get inflation back down to around 2%. But they don't want to crash the job market in the process. But real talk, when the Fed cuts borrowing rates, they're trying to make money cheaper to use. That can mean lower interest over time on things like mortgages, car loans, business loans, and even some credit cards. According to Investopedia, the Fed is cutting borrowing costs in hopes that easy money will boost spending and hiring. Translation, they want people to spend a little more, and they want business to hire, and the economy to keep moving. But without inflation getting out of control. Transportation stocks, including rail, trucking, and freight indexes, are performing strongly right now. Historically, when transportation companies do well, it often signals that business activity is picking up across the economy. That's why investors watch transportation stocks closely. But real talk, when transportation companies are moving more freight and goods, it generally means business demand is strong. That's usually a sign the economy is moving in a healthy direction. However, with the newly revised jobs analysis showing a slowing hiring trend, we'll be watching to see whether this transportation strength continues or if a slowing labor market starts to weigh on that demand. So there you have it. In case you missed it, the smart money news you can use. And as always, don't forget to like, subscribe, and turn on notifications to stay in the know. And if you want a deeper dive with real world steps, tap this playlist right here. And until next time, I've got nothing but love for you, and keep hustling.